Hello, good evening, everyone. Welcome to join today's webinar. Yeah, I'm your MC for today. My name is Lee Kwan Chi, and you can call me Casey. So, any questions or any comment that you may input in our chat box or question box? So right now, my first question is, can you able to see the screen clearly and also hear my voice clearly? If can, please type 1 in the chat box. All right, so let me see anyone can listen me clearly. Or for your information, the chat, if you are using PC, the chat box is on your top right hand side. And if you are using the mobile to join, you can just search the chat box in the below at the bottom. All right, so if you can hear me, can type 1 in the chat box. All right, so I saw somebody is reacting. Good. Okay, so I think everyone can hear me clearly. So yeah, so once again, my name is Casey, and let's kickstart today's webinar. So for the sessions, you may no need to record as we will be recording and we will post the recording in the next day on our YouTube channel. So if you miss it or like if you want to have a record, you can just go to our YouTube channel to have a look on today's webinar. All right, so just for disclaimer, today, the presentations is not reviewed by SC, so it is just for educational purpose. So if you wish to seek professional advice or on the market, you can just find the licensed broker or professionals like Phillip Capital. So we will be assisting you on this. All right, so let me introduce some of the background of Phillip Capital Sdn Bhd. So we are actually incorporated on 7 October 1995, which are wholly owned subsidiary of Phillip Capital's Holdings Sdn Bhd. So if you are our client for a long time, previously you were known that Phillip Capital Sdn Bhd is formerly known as Phillip Futures Sdn Bhd. So for information, we are the trading participants of Bursa Malaysia Derivative Berhad and also Bursa Malaysia Securities Berhad. So we are the holder of capital market service license as well. All right, so we can provide you the service professionally. All right, so for information, our affiliate office is located nationwide. So our HQ is actually located in KL, and upper side from Alostar until Penang, and down from up to down until JB Taman Molek. So for East Malaysia, we also have our branch, which is KK, Sibu, and also Kuching. So if you are from this area, you can just visit to our branch and the representative will be assisting you in for your queries, all right? So Phillip Capital is your first top choice of broker as we have won the Bursa Excellence Award in 2024. Okay, so our global network, not only in Malaysia, our exposure actually expand to worldwide. So from France, Turkey, Dubai, India, China, Japan, Australia, until US, UK. So actually, you can find us everywhere. All right. So in Phillip Capital, you can get exposure to the global coverage as well. So for example, you may trade the UK product, US product, European product, Hong Kong product, Japan, Australia, Singapore, and also Malaysia products. So you can just find this product in our platform. All right, so we provide you the one-stop solution for your trading. So actually, we covered futures, equities, and CFD for information. So if you are one of these trader and you are interested, you can contact us and our dealer representative will be assisting you, right? So why do you choose Phillip Capital as your broker? This is because we are the award-winning multi-asset broker, and also we provide you with the 24-hour broking and execution support. So we provide you the professional advisory service, and if you are our client, you can get the exposure to wide array of products and also the latest market news. So the last but not least, the most important is if you trade in Phillip, we will not charge you no platform fees. All right. So if you are interested in having one-to-one coaching session with the dealer, so you can contact us. So our dealer will arrange the session with you. So if you are our clients, as I said so, you can get the market views and updates because our analysts will also present on weekly views and updates to talk about the newly published report on every Monday, 11 a.m. And if you are technical analysis trader, so you can also find the weekly trends and potential entry and exit levels through technical analysis through our report for every Monday at PM. So, all right. So if you are interested in the upcoming seminar or webinar like this, you can scan these QR codes. So actually this QR code will lead you to our official website so you can have more information about the upcoming seminars and webinars. So if you are interested in opening account, you can scan this QR code. So after you leaving your personal contact information, our dealer representative will contact you to assist you in the account opening process. All right, so let me introduce some of our platforms. So for futures, we're actually using the NOAA platforms. So as I said so, if you trade in Philip, so you no need to pay the platform fees because this NOAA platform is actually developed by Philip. So we didn't charge our client or of any fees about the platform. All right, so you can get the features like indicators, buy or sell directly from the chart or market depth trading tool. And if you are a trader or investor, you must be familiar with what is trading view. So actually in Nova, our live chart is actually powered by the trading view, which you can buy or sell directly from the trading view site. So of course, you need to follow the TNC. And if you are interested, you can contact the dealer as well. All right, so for our stocks, actually, we are using Poems. So Poems provide you different features like all-in-one watch list, charting indicators, exchange top 30 movers, and market depth, and also powerful stock analytics tool as well. So if you want to trade stocks, and this will be the platform that you will be getting exposure to. So for information, our stock platform is actually right now it's actually having the promotion. If you invest the US shares and ETFs, you can get a low commission as low as 0.02% or minimum US dollar 3.99 with the TNC required. All right. So before we kickstart the webinar, let me introduce our speaker for today, which is who is Mr. Jose Blasco. And Mr. Jose Blasco is a seasoned trading expert with a strong background in derivative and digital assets, quantitative research, and also risk management. So originally an engineering professor, he applies a scientific data-driven approach to trading using statistical analysis, backtesting, and also machine learning to develop the systematic strategies. So he also lead to the creation and commercialization of the proprietary trading tools, working closely with institutional partners with an MBA and also CQF qualifications. He remains active in academia through finance lectures. So it is our honor to have Mr. Jose here in order to give up the webinar. So yeah, for free for our clients, right? So his unique blend of technical expertise, market insights, and also practical business experience allows him to bridge research, strategy, and also real-world execution effectively. So yeah, without further ado, let me introduce Mr. Jose, and also let me pass the floor to Mr. Jose for his time. All right, so let me make
Wonderful.
presenter.
Thank you so much, KC. I can see the permission on my screen. I'm about to share screen with everybody. Thank you, everyone, for joining us today. I'd love to get a quick confirmation, if that's okay, that my sound is good, that everybody can see my screen. It would be fantastic if you could give me a quick yes on the chat box as well. Actually, I would love to interact with you during the session through the chat box. So
Mr.
please.
Your voice is good.
Okay, wonderful. Yeah. I don't seem to be able to see the chat box. Maybe I don't have the permission for that. But anyway, we'll do Q&A at the end. Let's get started, everybody. Well, again, official welcome from my end to the session. Today we are talking about volatility. Volatility is a funny word because depending on who you are and who do you talk to, different people use the word volatility to represent different things. So it's very important that, first of all, we speak the same language, and most importantly, we then dive into how to use volatility for our convenience, for multiple possibilities on various applications, and how can we do that safely? That's a key concept. So I'm gonna have to start the session talking about volatility more generically, then move into VIX, which is the volatility index, VIX, V for volatility, IX for index. And then we'll talk about futures, VIX futures, which I would assume that many of you in the group with us have traded futures before. I would also assume that many of you have never traded futures before, and it's okay because I'll guide you to understand this. No worries. Finally, towards the end of the session, we will move into applications. I will also move from slide decks to utilizing real-time charts. Okay, so we can do some planning, some outlook, some understanding of what's happening out there, and again make this session as practical as possible, given the fact that we have very limited time together. Okay. By the way, talking about limited time, I tend to speak fast in case you have not noticed yet. So hopefully that's okay, because we have lots to cover, but at the same time, please, I am here for you guys. So if there is anything that you need me to repeat, just type it on the chat box, okay? And either I will re-explain it as we go, or we'll talk about it during the Q&A. I want to make sure everybody gets this. This is what I would call a pretty unique lesson for us, because not everybody understands volatility, and you should. Okay, so everybody listens carefully, and please work with me on that. So again, foundation, what's the VIX, what's VIX futures, and then applications. And by the way, I didn't mention, I have a few bonus resources for you at the end of the webinar. I'll have a few QR codes for you to get access to tools and resources that are free, free forever. So that will probably be also appreciated by you. Anyway, so my name is Jose. Again, Casey has introduced me very well, so thank you for that. I'll skip the slide and dive into the lesson. Anyway, so let's talk about risk, right? And let's understand risk versus volatility, right? So I think if I was to say no pain, no gain, right? Which is something that sport athletes say all the time. I remember the time of Lewis Hamilton in the Mercedes Petronas Formula One team. He would always say no pain, no gain, and it's so true. Well, in trading, no pain, no gain would be said as no risk, no reward. It's the same concept. It applies to sports. It also applies to trading. If we were to talk about we want to trade, but we want no risk at all, well, then it's basically impossible to make a profit, right? So we need to be open to have a certain type and a certain degree of exposure to risk in order to have also exposure to opportunity. The key is to try to create a system or a scenario where your exposure to risk and to reward is asymmetric. So when your risk is less and when your profit is more, that kind of thing, you still need to be open to assume a certain level of risk. But the idea is to do it only for the purpose to collecting juicier rewards. Okay, no, not only for the sake of let's see what happens. That would not be serious. Now, obviously, the concept of risk, which I believe you probably agree with what I said, no risk, no reward, it's often misunderstood. And when people use the word volatility, they basically make an equivalency, and they talk about risk and volatility like it's the same thing. And it's absolutely not the same thing. Volatility, if you want to think about it in a way that is different compared to what you're reading on the slides, volatility could be seen as speed of movement. And for sure, when a market is very fast and moves very, very fast, you may get a bigger slap on the face that happens quick, or you may get a very nice, very, very juicy profit that also happens quick. So in other words, speed of movement has an impact on risk and reward, that's for sure. But the real impact when it comes to risk and reward of volatility has a lot to do with timing and the size. Let me explain. So let's say you trade stocks. Today we're talking about futures, but let's say you trade stocks, and let's say you buy one share. So if you only buy one share of stock, even if the stock is moving very fast to the upside or to the downside, it doesn't matter. Your exposure to risk is very little because you only have one share. Whereas if you were to buy many shares, even a slow moving market may represent a lot of risk for you because your position size is very, very large. So the first thing I want to do in today's presentation is to differentiate that risk and volatility is not the same. Okay, that's the first thing that I want to differentiate. Then on top of that, now we need to dive deeper into volatility. We will actually learn that there are two types of volatility. So there are a few subtleties that I need to start the session with. So please listen carefully. This is important. So then finally, then we can get into how to trade it and how to use it. Okay, but it's very important to understand those subtlenesses that you may trade a market which is not volatile at all, but then your position size is too large, and then you are actually taking a lot of risk, right? So it's a different thing. Now, the type of volatility that we're gonna measure utilizing the VIX. Okay, this, by the way, this is the VIX, VIX. Okay, volatility. Okay, and notice it says volatility S&P 500 index. Okay, so if I type SPX, CBOE, Chicago Board of Options Exchange, okay, SPX. So this is the S&P 500 index that is basically starting to make all-time high today as we speak. Okay, so very, very timely day to do this session. So as the S&P is making all-time high, so there is a certain level of volatility in the marketplace. Okay, there is a certain level of volatility in the marketplace, but there are two types of volatility. Okay, and I'm gonna come back to the slide in a second, the prior slide. There are two types of volatility. One thing is the realized volatility. You may want to think about it like the little mirror in your car that allows you to see backwards. Okay, so you have a backward-looking perspective. For example, if I take this chart of the S&P, let me hide everything, and let me add a historical volatility indicator. This comes by default in all trading platforms. By the way, I am utilizing TradingView, which, by the way, you could connect to your Philip account. So you are now seeing a reading of 13.44. That's the level of historical volatility that we have. Historical volatility, also known as realized volatility. So the current number that we see on the screen was 13.44. So if I was to type here, let me see, give me a second. Okay, I'm not sure why I'm not able to. Okay, here we go. So 13.44, okay, that's going to be a percentage number. And basically that number that we measured represents that if the S&P, in this case, the S&P 500 index, which I assume most of you would have heard about it, isn't it? It's the largest equity index market in the world. It's like the Kuala Lumpur composite index, the KLCI, but instead of only Malaysian stocks, it's the 500 greatest stocks in America. So that's the S&P 500. So if the realized volatility for the S&P 500 is 13.44, what this tells you is that the speed at which the market has been moving at, remember volatility is speed, so the speed at which the market has been moving at represents potential for the market to be either up or down 13.44% in 1 year. Volatility values are always annualized. So that number tells you what already happened. The speed that we had in the past is pointing out 13%, 13.44% yearly range. Is not telling you it's going to go up or down, but it may go up 13%, it may go down 13%. That's what this realized volatility is telling you. It's telling you what the speed of movement has been past tense. Now, implied volatility, that's a different animal. Because implied volatility, that's the one that we care about. That's the one built in the VIX. Okay, the implied volatility is coming from the options prices. And today we unfortunately do not have time to talk about options. But basically, I want you to think about options on the S&P as insurance policies. And in this case, for you to understand this well, if you don't trade options yet, I want to talk about real estate. So let's say you are trying to insure a property that you own in KL, and the value of the property that you are trying to insure is 2 million ringgit. Okay, so you have a 2 million ringgit property in KL. You want to insure it, so you go talk to an insurer and you buy home insurance. Okay, of course, depending on, you know, do you need it for a month, do you need it for a year, depending on a series of conditions, you will get a specific quote. And let's say you take that quotation and you decide, okay, I'm going to buy it. So now you buy that insurance policy. Great. Now let's say another person, okay, another person has a property which is worth the same, also 2 million ringgit. But instead of KL, okay, maybe the property is, I'm just gonna pick Miami in the US. And the reason why I'm thinking of Miami is because there is risk of hurricane in Miami. Almost every year, a hurricane will hit Miami. So the value of the property is the same, 2 million ringgit. Okay, we are not even changing currency to US dollar. 2 million ringgit is the value of the property. But now when you go to talk to the insurer needs not only to price in the insurance for the home, but also the risk of hurricane. And therefore, the premium you will need to pay for that insurance policy in Miami is going to be much more than the one you would pay in KL, because in Miami, you have hurricane risk. Again, we are talking about same duration of the policy. We're talking same value for the house, same items in the house. So again, I'm just talking about the environment. In this case, the fact that there is a danger of a hurricane is changing the price of the insurance policy, no matter the price of the asset. So in trading stocks, the same thing happens. When you look at options on the S&P, okay, so we're talking about financial insurance to insure a portfolio. The options, call options, put options, you may have heard of them. They also are an instrument that has an expiration date, like an insurance policy. And when you buy or sell calls, you also pay premium. So when you look at all the options in the market, okay, so if I was to come in here and where is my option chain here? Here we go. If I was to load an option chain on S&P, for example, so you have all these options here that are loading, and all these particular options got a specific price. So what happens with those specific prices? If you were to look at the prices of the options and you were to reverse engineer the prices of the options, you would conclude how much of a risk of hurricane is perceived just by looking at the premium of the options without even looking at the price of the S&P. Okay? And that's what the implied volatility is. It's the volatility that is priced in the options prices. And therefore we say that that speed of movement, instead of speed of movement using the rear mirror, that speed of movement is forward looking, because people are buying options now expecting a hurricane or not, right? And therefore, the more expensive options are, the more volatility they have priced in. The cheaper options are, the less expected volatility they have priced in. And you could actually, all of those options pricing models and all of those things is basically math, very advanced math. So you could actually compute all of these and end up with an index, which is the VIX, which looks like this, VIX CBOE. Here's your VIX, and it looks like that. And currently it shows 18.24, which means that while the market is moving at a rate of 13%, options tells us that the market participants are buying them expecting a little bit more of a spice. They don't expect the S&P to move at a rate of 13. They expect the S&P to move at a rate of 18.24 in a year. Okay, that's what this is telling you. So this is the first level of understanding I need from all of us. So at least you know what's the VIX. Of course, we're going to talk about how to trade it, which is the most important part. But it's important to understand that the VIX is basically representing that expected, which is future, not past, that expected 30-day annualized volatility of the S&P. And you know, it's very, very convenient to see it plotted as an index, right? Take a look, if I zoom out, that, you know, the VIX kind of goes sideways, okay, through time. And we're looking now since 2013, right? So many years of data. And we can see that it tends to go sideways, and sometimes it goes up. In this case, it went up to 30%. So at that case, it went up to 50%. During the pandemic, it went up to 80+%. So The hurricane was perceived as the S&P would move either up or down 85% in 1 year. So that's impressive. In the recent times, like for example, Liberation Day, we got to see VIX around 60. Okay, when the war of Iran started, we saw the VIX trading around 35, and currently, as we are about to make all-time high in the market, people are getting calmer and calmer. There is no expectation of a hurricane. There is expectation of good weather, at least in this short term, and we can see the VIX trading at 18, which is, it's not that low. It's been much lower before, like as low as 8 down here. So now it's 18 instead of 8, but we can see it's definitely not as high as it has been. Again, we need to talk about how to trade this, okay? On my way. Now, for the ones of you who are extra curious and maybe you like math, I just wanted to give you a little bit of a trick. It's what we call the rule of 16. Why 16? Because 16 is the square root of 252. If you approximate to the next number, it's 16. And why 252? Because we have 252 trading days in 1 year. So square root of 252, it's more or less 16. So if you take VIX, okay, let's say VIX is 20, and you divide it by 16, you get 1.25, and that is the daily expected move. So based on the levels of options prices, we expect the S&P to go up or down 1.25% into tomorrow. Okay, this is one of the applications of VIX, which again, I'm going to talk about things that are way more useful, but so far just getting you into the mood of understanding Mr. VIX, because it's a different asset. Okay, it's a different asset. Talking about different assets, like for example, when you look at this chart, and feel free to comment on the chat box, or if you want to have a question about this, how would you feel about buying and holding long-term the VIX? Do you think that would be a good idea? Okay, how would you feel about buying and holding the VIX long-term? And how would you feel about buying and holding long-term the S&P index? Okay, so feel free to comment on the chat box. Not only feel free, I'd love you to do it. Okay, so I know I'm not talking to myself here, and you're here with me, but I would love to hear your thoughts around that. So please do not be shy. I guess we're all adults here, and we are talking about something serious, financial markets. So please go ahead and work with me on that, if I may suggest. So anyway, I'll come back to this and I'll give you a proper answer. No worries. Okay. Anyway, so now the VIX, now that you know what it is, you can see it's a different animal, and you can see it's very useful because it could help you to understand the market environment from a different angle. Okay, you could understand if there is risk of hurricane or not before you go take a walk. That's very, very important. Okay, but before we get into how to trade it, I need to say you cannot trade the VIX. The VIX is an index. Is the math I mentioned before, where you reverse engineer the options pricing models to conclude what's expected, 18 point something percent. So that's not tradable. It's an index. It's math. It's a calculation. To trade it, we need to convert VIX into futures. That's going to be our bridge. We're going to be trading VIX futures, just like you cannot buy S&P. You cannot buy S&P. You can trade S&P ETF, S&P futures, but you cannot buy S&P. It's an index. You cannot buy VIX. It's an index. You need to trade VIX futures in this case. So if we look at VIX futures, and I understand that many of you probably have never traded futures before, so I'll give you a 2-minute crash course on how futures work. So take a look. If I look at Tenaga to pick a stock, that is a stock in Bursa Malaysia. And I believe that most of you are probably familiar with Tenaga. And if I show you the price scale and we zoom in, okay, and we zoom in, so we can see here Tenaga, where we can see that the price differences are 2 cents at a time. So Tenaga moves up 2 cents at a time. Tenaga moves down 2 cents at a time. Okay, 14.16, 14.18, 14.20. That's 2 cents at a time. If instead of looking at Tenaga, I look at VX, okay, CBOE, volatility index futures. Okay, if I look at VX, notice that when I zoom in, okay, the price movement is 0.05 at the time. So instead of moving 0.2, it's moving in what we call in future ticks, which in this case is 0.05. Okay. Now, that's one difference between trading stocks and futures. Another difference between trading stocks and futures is that when you buy stocks, I'm assuming Bursa Malaysia stocks, you can only buy them. You cannot short stocks in Bursa Malaysia. For the ones of you that never shorted before, or you don't know what shorting is, shorting means making money on the way down, where going long means making money on the way up. So for stock trading, you need to go long. That's all you can do if you trade Bursa Malaysia stocks. With futures, I got two buttons there, buy or sell. I can go long or I can go short. I don't need to own to sell. I can just sell without owning. That's shorting. And that helps you to make money on the way down, whereas buying, as we know and as it is intuitive, helps you make money on the way up. Okay, so you can make money on the way up, you can make money on the way down, and futures give you that flexibility. So difference number one between trading stocks and trading futures is that when you trade stocks, each stock will have, different level of cents. With Tenaga, it was 2 cents at the time. With futures, we don't call it cents, we call it ticks. And in the case of VIX futures, is 0.05. Second difference with futures is that you can go long and short both, not long only. Third difference is that this market, as you will see in a moment on a slide, is open 23 hours a day. Where the stock market may be open 5 or 6 hours a day, this market is open 23 hours a day, only closes 1 hour per day, which, to be specific, is between 5 a.m. to 6 a.m. Malaysia time, which you are probably in bed anyway. And when you get up at 6, you can now go ahead and trade. Another difference between stocks and futures, and I'll stop there with differences, this is the last one I want to mention, is that when you trade stocks, you have to own it. So if you want to trade Tenaga back to Tenaga, which is currently 14 ringgit and 22 cents, and you want to buy 100 shares of that, so you need to spend 1,422 ringgit, right? Because you buy 100 shares times 14.22. So you need to come up with all the capital required to own it, and then you buy it long. Okay, that's stocks. With futures, you don't go through ownership. And because you don't need to own it to trade it, you just need to use what's called margin. So you come up with a limited amount of capital that is being kept on the side by your broker while you are in the trade. But that limited capital, which is called margin, is much less than the amount of money you will need to pay if you were to own it. Okay, which we don't own with futures. Okay, that's the beauty of futures. We don't deal with ownership. We deal with price movement, but no need for ownership. So you are trading in a way that is more efficient. So VIX futures specifically trade in the CFE, which is the CBOE futures exchange. It's like Bursa Malaysia, but it's not in Malaysia, it's in Chicago. And the CBOE is the largest options exchange in the world by a lot. And they also have a futures exchange on top of the options exchange, and that one is called the CFE. That exchange is amazing, is large, really large, truly large, but on top of that is regulated by CFTC, which is the US regulator, and on top of that, it's also approved by Bank Negara, Securities Commission, etc., which is why Philip Capital, also known as Philip Futures, can provide you easily with access to such market, because it's not like they have the charts and that's it. Actually, you can trade it. You can go long and short like you would do palm crude oil in Bursa Malaysia or Tenaga shares. You can actually, as easy, do your VIX futures trades. Now, specifically, VIX futures has a ticker symbol which is VX. It's not Tenaga, okay, or Maybank. No, it's VX or VXM, which is the mini contract. Okay, and this is something very relevant. Okay, it's the mini version of the contract, which is a tenth of the full contract. Okay, so if your account size is smaller, or if you are doing baby steps into understanding VIX and trading VIX futures, instead of going full size with VX, you can trade VXM. You get the same chart, you get the same value, everything is the same, but each contract is 10 times less. It's like instead of a share is a share, it's like one share is a tenth of a share. So you have less risk, you have less requirement for margin, so you can trade it with less money and with less risk. And that, of course, depends on your size, on your decisions and how your trading style goes. In a moment, I will do some demonstrations with the live chart, and you will see that in action. Okay. Now we saw the tick is 0.05, and if you trade VX, which is the full size, then every time you get a tick in your favor is $50, US dollars in this case, not ringgit. But remember, you can also trade VXM, and therefore, instead of 50, then it would be $5 per tick, okay? $5 per tick, okay, which is 0.05, okay? Which is 10 times less compared to 50, okay? So you choose, do you want to trade the VX or do you want to trade the VXM? Okay, that's obviously your decision to make. Trading hours, 23 hours a day. And then margins, they vary. If you are trading VIX using short expiration date, you have higher margins, up to $8,000 per contract. This changes through time. Okay, during Liberation Day was more. At other times, during the market cycles, it may be a bit less. But this is a valid range to keep in mind. Anywhere between 2,500 to 8,000 is what you need per contract, or 10 times less if it's the VXM. The weekly expressions are less liquid, so even though they exist, I will not mention them, and because they are less liquid, notice they also require more margin, so not ideal to trade the weekly expressions. And then we can also do future spreads, which this I will just at the speed of the light demonstrate at the end, because it's a bit maybe a bit too much for today's webinar, even though we will do more webinars together. Okay, Philip has put multiple dates in the calendar already where I will come back and dive deeper into VIX, including some in-person events in KL and JB and Kuching. So, hopefully we can shake hands in person at some point, and we'll dive deeper into all of those things. But the point is that future spreads means that you buy one futures expiration and you sell another expiration against it. So it's like you trade VIX against VIX. And because you trade VIX against VIX, then the difference is the differential, and therefore margin is less. So you can see margin can go as little as 600, which if you do VXM, it will be 60, right? So, but anyway, this is something a bit more sophisticated, which I may have time to discuss today, or definitely in another webinar. So take a look. If I type VX and I expand my list under futures SIBO, which is CFE, I got many expiration dates. I got futures May expiration, futures June expiration, futures July, August, September, October, November, December expiration. So you can see there are many different expiration dates. Now take a look at this. I'm going to add the VIX, okay, which is currently pointing at 18.22. And you can see it says the VIX is not tradable. Of course, we need to trade VIX futures. Okay, we can see that. Then let me add VX, and let's use May expiration, okay, in a new pane. Have it down below. Then I'm gonna use VX, and I'm gonna use June expiration, and then I'm gonna use VX, and I'm gonna use July expiration, and I'm gonna stop here. So I got the VIX index on the top pointing at 18, and then I got the May expiration pointing at 20.550, and then the next expiration pointing at 20.92, and the next expiration pointing at 21.61. So notice that when I trade VIX futures, the further out in time I trade, the higher the price. And remember, the price of VIX is not the price of, it's not the price of milk. It's the expectation for future movement in speed. So there is more expectation for future price and speed in the future compared to short term. which makes sense. And this is what we see all the time with VIX. With VIX, we always see this phenomenon in futures trading is known as contango. I have a slide in a moment where you can see this written. Contango means that there is less expectation for trouble in the short term and more expectation for trouble in the far term, because the more the time, the more you open the door to things happening, like a war to start. If I ask you, what do you expect from the market from now until next week? Well, you may expect whatever you expect, but probably if I ask you, what do you expect from the market from now until 10 years later? Well, probably you're telling me, well, we're going to have multiple wars. It's going to be the AI revolution. It's going to be this. It's going to be that. So you would have more fear, if you wish, into the future, or more expectation for craziness to kick in versus in the short term. So this is important for you to keep in mind, because you need to know that futures trading tends to converge to the VIX futures price. So notice what would happen to you. This is important. Listen to this very carefully. What would happen to you knowing that VIX futures, I'm going to point at the front month, tends to converge to the VIX index on the expiration date? So if the current value of the VIX futures is 20 and you buy it, and you know that as time passes and we get to May expiration, the value of VIX futures will converge to the value of VIX index, and you can see the VIX index is less, you basically would collect a guaranteed loss. You would be guaranteed a loss if you were to do that, right? So again, coming back to the question I asked you earlier, do you think it's a good idea to buy VIX and hold it long term? Well, I guess you are seeing already some of the answer to this question, which is no, okay? The VIX is an instrument which is an asset class by itself. Like you trade stocks, and you may trade gold, and you may trade crude oil or natural gas or palm crude oil, or you may trade Bitcoin or crypto digital assets, and you may trade, silver, and also you may trade agricultural products like wheat or corn futures, you name it. So all of these are different assets. But guess what? Volatility also is an asset that you could buy and sell just like you buy gold, but not to hold it for the long term. You would want to enter long or short. Remember, you can play both directions. So with a percentage of your capital, you may want to enter long or short, but be in and out, fairly quickly. And I will show you what I mean by fairly quickly in just a second. So normally we have a contango situation, which is traders around the world expect less trouble into the present or the near term and more trouble into the future. And therefore, options prices reflect that. And therefore, the VIX futures provide this contango curve where future expiration dates are more expensive than shorter expiration dates for the VIX futures. Now, there are times where we are in a backwardation situation. This does not happen often, but it does happen. For example, Liberation Day. For example, a few days when the war in Iran started. So when there is something short term, which is very potentially problematic, then many people are protecting their portfolios, either buying a lot of calls or puts, or buying a lot of futures, or shorting a lot of futures, depending on what they trade, using the short-term expirations, because they perceive the short term as the problem, and they expect the world will be better in the future, but short term they expect a problem. So then it changes to backwardation, right? So this is important to know, because in a moment I'm going to show you various applications of VIX. One of them will be to trade the term structure. This is known as the term structure. And if you wanted to trade VIX long term, which I said you should not, well, actually you could play the long term term structure by doing futures spreads, which again is a more sophisticated concept, which I will demonstrate quickly today. Hopefully I have time. So at least you get to see it, and more to come in the following webinars. Something to know as well about the VIX and VIX futures is their inverse correlation with the S&P 500. So typically when equities go up, the VIX goes down. And this, to be honest, it's very clearly seen here. We can see how the VIX has been going down. And as the VIX has been going down, if I show you S&P 500 index CBOE, so you can see how the market has been going up. So 78.5% of the times, when the equity index goes up, the VIX goes down, and vice versa. Therefore, a typical application of VIX futures is hedging. So what is hedging? Hedging means that you have a portfolio made of stocks. You are concerned something bad is going to happen in the marketplace and that your stocks are going to get hurt. So instead of selling your stocks, you want to keep them because maybe they pay dividends or something like that. But if you don't do something and the market does crash, you're going to get hurt. So what can you do? Well, you can buy VIX futures together with remaining in that stock position that you have. And if the market does tank, yes, your stocks will get hurt, but guess what? You will be making a profit on the VIX futures because when the markets go down, the VIX goes up 78.5% of the cases, and then your futures position would very likely make a very nice profit. Also remember, you don't need to come up with all the money needed to get into VIX futures, which means that with little amount of your unutilized capital, you can protect a portfolio quite efficiently. So that's one application, which is hedging. There are other applications such as speculation and diversification. I'm gonna get into speculation right now. I guess this is what will be the most fun part of the session. Even though time is going so fast, I keep looking at the time. But I want to point again at diversification, that you should start thinking about the VIX like another asset, like gold, right? So let's say you always traded stocks and never traded gold, and one day a friend told you, why don't you add gold to your portfolio to diversify? And you did, and that helped you very much, especially recently. So you'll be very happy about being diversified. So you want to think about the VIX the same way. It's an asset that has its own characteristics, and therefore you could add it to a portfolio to add diversification. So the four key ways on how to utilize VIX futures would be mean reversion, trend and convexity plays, term structure spreads, and event-driven trading. So there is a lot here, okay? I'm going to explain this quick on the slide because I want to spend time on the charts before we complete the session today. So convexity plays means that the market is crashing and you catch this rise on the VIX. That's what it is. So you are adding convexity to your portfolio. If that term is new to you, basically it means that no matter if the market goes up or down, you make money. That's convexity. So in this case, you have stocks, the market goes down, you are losing money on the stocks, but because you are long VIX futures, you are making money anyway overall if you add all the positions together. Another very interesting play is what we call the mean reversion. Okay, why mean reversion? Well, because if you look at the chart of the VIX, back to VIX. So the VIX is full of situations where people thought the world is ending. Oh no, it's not ending. The world is ending. Oh, it's not ending. The world is ending. No, it's not ending. The world is ending. It's not ending. The world is ending. Not ending. Now the world is ending. No, not ending. Right. So it's these fear levels, right? This increase on implied volatility, like as an extreme in the pandemic, where the VIX was pointing at 80+%. Traders expected the S&P to move at a rate of 80+% in a year. That's crazy. So that level of fear is typically not sustainable. And again, fear goes faster than the speed of the movement of the market. So often you end up having these exaggerated moves on the VIX when things get bad, which is fantastic to protect a portfolio. But because you make money in an exponential manner when a portfolio is being hurt, so you can hedge very efficiently. But then when the explosive move has taken place, you don't want to think about the VIX like it's in an uptrend. I'm going to buy now, because you are buying right before it's reverting back to the mean, because this is a natural characteristic of the VIX. It tends to revert back to the mean. Okay, so let's talk about a few applications here. Okay, I'm gonna use VX1, which is the front month expiration for VIX futures. Okay, so CBOE Volatility Index VIX futures. Okay, and I'm going to pretend, I'm going to drop this to a 10-minute time frame, and I am going to pretend that instead of today, so today is first Friday of the month, and the reason why I'm pointing at first Friday of the month, which is April 3, Friday, is because every first Friday of the month, we have the unemployment rate reported at 8:30 a.m. New York time, which is 8:30 p.m. Malaysia time. So let's play the news. Okay, that's a speculative type of approach. And I'm going to move to on the chart April 3. And notice that if I put a vertical line, I need to look at 7:30 a.m., by the way, not 8:30, because this is Chicago. Chicago is 1 hour difference with New York. So this is 7:30 a.m. in Chicago. And if I was to draw a little box there, I could pick the top, I could pick the bottom. So this is the trading range that was taking place before the unemployment number. Then the unemployment number becomes valid. And now whatever expectation was built into the number being reported, which by the way, you could have traded that too. So now the expectation is gone. Everybody becomes calmer because now everybody can see the number. So everybody becomes calmer. There is nothing to fear anymore. There is nothing to expect much anymore because now you have seen the number. It's reported. It's public. So what happens? The VIX futures goes down and you can short it. So let's say, and this KC, I'll do a little demonstration on the screen now, and then I will pass the screen to you because of time constraints, so we can move into Q&A. But very quick here. So let's say you have taken a trade here at this level. So this level is coordinates 25, 4 to 5. Okay, so 25, 4 to 5. Okay, the level above is 25, 9 to 5. So I would have a stop at 25, 9 to 5. Okay, so you can short VIX at this price level with a stop above in case you're wrong. Okay, and it does something funny, which is it goes like that and then stops you out. Okay, because then it's going to continue going higher, which is why I waited until after the report to minimize that problem. But of course, anything could happen, so we have to protect ourselves. Remember, we're trading volatility, but we do it with risk management. Okay, don't confuse volatility and risk. We're actually being safe here. And let's say you take a profit here, 23,820, for example. So 23,820, that would be your profit taking. So what would happen here? Well, you have a trade where you were risking 500 to make 1,605. That is a 3.21 reward to risk ratio. Pretty nice. And remember, the beauty of volatility is that this happens fast. So this is like maybe a 1 hour or 2 hour trade. And by the way, talking about size and risk, if risking $500 is too much, you just do this with VXM, which is 10 times less. So now you are risking 50 in order to make 160. Okay, or you do 2 contracts of the VXM, so now you're risking 100 to make 320. Okay, so I guess you get the math. Again, we just spent some time discovering the VIX. Little by little, there is so much to discuss about this asset. It's a different animal, which is why it's a good asset to have as a portfolio diversification strategy. No one really talks too much about this, especially in Malaysia. So Philip is being very innovative at bringing this in front of you guys. So open your eyes, and hopefully this first session together is enriching enough for you to take a deeper look. And of course, I'm excited for the coming sessions as well as for looking at your questions. So Casey, I know I'm taking a little bit of extra time here, but go for it. If there are questions, I'm happy to take them.
All right. Yeah, it's okay, Mr. Jose. So, like, I guess we received some questions here. So, yeah, without wasting time, the first question is, can the VIX ever give false signals? So, if so, how should traders filter out the noise?
No false signals. The VIX is based on the options from the largest equity index market in the world. whatever number is calculated by the CBOE, it's a real number. There is no such a thing as false signals or anything like that, including what I said. The VIX is not even tradable. It's an index. So whatever you see is what it is. It represents the real expectation in the market. So then you trade VIX futures. But what you see on the VIX is what it is.
All right. So now let's move on to the second questions. Do you encourage using VIX futures as a hedging tools for portfolios, given that it's not ideal to hold for long term?
Correct. That was one of the points of today's presentation, isn't it? So you have a portfolio made of stocks. You now have concern, like for example, you are getting into the weekend, and you know that the U.S. administration will negotiate with Iran a potential exit or maybe not of the war. For example, this is something that just happened a few weeks ago, right? A couple of weeks ago. So what can you do in a situation like that? Well, maybe before getting into the weekend, you get into a VIX position, and after the weekend, maybe you unwind it, okay? But during the event, during your concern, whatever that is, you can use the VIX as a hedging tool to protect a portfolio, yes.
All right, so due to the time concern, I think we need to choose for the one last questions. Right, so in a contango market, will long positions in the VIX spread more likely to lose money?
It depends on your position. If you're in a contango market, what you would typically do, and we'll discuss this more in a prior session, but you would do what's called a negative roll yield strategy. Oh, by the way, I need to share a few QR codes at the end. I said I had free resources for the attendees, so I'll do that right now. A negative roll yield strategy means that you buy the short-term futures and you sell the long-term futures, and now you benefit from the price difference between those two. Yeah, very good questions.
All right, so I think, yeah, this is a QR codes that allow investor or trader to scan with. So like you can follow the TradingView profile or subscribe the YouTube channel. Yeah, so all right, so let me just do an ending speech for these sessions. All right. So like if you are interested in opening an account with Philip and trade VIX right now, so you can just scan this QR code. So our dealer will contact you as well for after you leaving your informations. Right. So if you wish to contact us, yeah, you can just find us on this platform. So for example, Facebook, YouTube, Telegram, LinkedIn, TikTok, and also our official website. So including today's webinar, we will be posting the record onto our YouTube channel. Yeah. So if you want to have a recall, then you can go to view the video as well. So if you are interested in trading stocks or futures or CFD, yeah, you can scan the QR code as well to join the Telegram group, as we will update on those recaps or market news on these into our Telegram groups as well. All right, so last but not least, I'm Casey from JB. If you want to find me and if you want to like hang out with me, so you can find me in this address. So if you want to call our office, then this is our phone number and also this is our email address. So if you are not from this area, yeah, so we have other branches as well. So these are the branches contact informations, and for your information, our HQ is located in KL. All right. So yeah, thank you everyone for coming and joining today's webinar, and thank you, Mr. Jose, for the webinar. It's a wonderful sessions. So yeah, goodbye everybody, having a good night. Right. Thank you.
Thank you, Casey. Thank you, everybody. Bye-bye.
Yeah, bye-bye.